Welcome to the Valmika Property Investing Podcast. I'm JP, your host and the founder of Valmika Buyers Agency. With my background in investment banking, I'm here to share Wall Street tips and secrets for building a top 4% property portfolio. Let's dive into the world of property investment together. Welcome to another episode. Today's topic is a request from one of the listeners, and it's one whereby I think it will benefit many people. The topic is residential property investment cheat sheet. So this is the cheat sheet I would recommend you use if you're going about purchasing a residential property for investment. So I'm going to speak about a few various sections under this topic, and the first one is defining investment goals. Then I'll move on to understanding your risk tolerance. I will then speak about location dynamics, then the numbers game, then lastly building your investment team before I move on to the various strategies for success. So let's get straight into it. Right, defining your investment goals. This one is how we balance and diversify people's portfolios. So it's all got to do with cash flow versus capital growth. Sometimes, not all the case, you might need to sacrifice capital growth for cash flow and vice versa. In some instances, we are able to catch new and growing suburbs in the residential space where you get some good cash flow and great capital growth dynamics with it. So the first thing to look at is when we build a portfolio, everyone's portfolio is different, but where we generally like to start is with putting in or placing you in a residential investment in key capital cities. Why we do this is because you want to grow a strong financial base first. The properties surrounding major capital cities tend to weather the storm better than regional. And that is because the major economic hubs happen around these cities and people need a place to live. When people are under financial stress, the first properties they look to get rid of and sell are the holiday homes. So if you're going to invest in a property in a holiday jurisdiction, it is a higher risk for depreciation when there is a depression, for example, than compared to those in major cities. That is why we like to build a strong foundation first there around capital cities. We then like to diversify and go for cash flow versus capital growth because it allows you to stay in the game when interest rates get high, because you've got that strong cash flow dynamics coming in to balance out your portfolio. That we can go into more detail, but in general as a topic, that is the first place to start, is where do you want to get your next property if you're starting off or if you are adding to an existing property portfolio. So here you just need to determine your primary goal. Do you want to initially prioritize generating regular rental income or maximize long-term property value appreciation for capital growth? That's a good place to start. Next is understanding your risk tolerance. So there are various factors to consider when considering your risk tolerance. First is your investment horizon. So consider your investment time frame. Are you looking for a short-term return or building wealth for the long haul? Keep in mind that short-term investments, it sounds strange for property investments. There are areas where you can gain a short-term uplift with a property, and that generally takes a higher risk dynamic attached to it. And I'll give you an example. If, for example, there is a mining town that is being set up that is going to mine a certain mineral that is probably that'll run out in the next couple of years, there'll be an economic boom in the area. So you might take a view of purchasing a residential property in that area and hold it for a year or two and try and catch some of that growth. But you know that for the long term, it's riskier because there's only so much mineral in that area that they can mine, for example. And then once it's mined, it'll close down and the economy in the area will decline on the back of it. So that's a classic example. So it's all got to do with your risk tolerance, whether you want higher returns or do you prefer a more conservative approach. Next one is obviously the most important one, and that is location, location, location. You've heard that many times. To determine the location, you need to do research and market analysis. So conduct a thorough research on different suburbs and property types. But what do you look at when you're doing your research? So the main ones to look at are stuff like rental yields, vacancy rates, infrastructure projects that are around supporting the suburb, and future development plans. Areas with a lot of capital being thrown at infrastructure and development tends to gain momentum in the area for growth. So those are good things to look at. Next, understand the demographics of the area. So consider the target tenant demographic for your property and research factors like employment hubs, proximity to schools, and amenities that cater for your desired tenant base. At Valmika Buyers Agency, we take this a step further. We are ex-investment bankers, so we look at how different demographics are influenced by fiscal and monetary policies around the world. You know the saying, when the US sneezes, the rest of the world catches a cold? It's very true. It's important to understand what's going on economically in the US, and especially with China and especially with Australia. China is very important as well. So it's important to gauge on the economic policies and the interest rate cycle that is occurring in that economy, as well as Europe. So those are the three major economies that we consider: America, Europe, and China, and how they affect the different demographics in Australia and the policies in Australia. It's very important to understand this to invest in the correct demographic suburbs that would relate to the economic lift on what's happening globally. Next topic is it's a numbers game. So financial due diligence is very important. Under financial due diligence, what do I mean by this? So this is, again, got to do with the purchase price versus the rental income. You've got to understand how these two dynamics affect the yield in your property. If you're looking for positive cash flow properties, for example, and this is when you've got an established portfolio, you might be considering commercial property. The commercial property cheat sheet, by the way, I will release next week. So I'll do a podcast on that next. But anyway, so positive cash flow properties, for example, you need to ensure that the property generates sufficient rental income to cover your expenses, such as your mortgage repayments, rates, property management fees, and ideally provide a net positive cash flow. It's difficult to do that in a high interest rate environment like we do have now. However, if you get into a 5 or 6% yield with interest rates coming down over the next couple of years, you may find that you will enter into a positive cash flow territory depending on the suburbs that you invest in. You also need to factor in long-term costs. So consider the potential future expenses like maintenance, repairs, and potential vacancy periods when calculating your returns. Vacancy periods become a lot more influential, especially in regional areas. So it's important to understand the economy in the regional areas, and a good way to see that is through the vacancy rates too, to see how strong the economy is and the demand for rental properties are in those areas. The next point in the cheat sheet will be around building your investment team. You can't be the expert at everything. So you need to leverage off professional people to leapfrog you and into the right investment property and make the right investment decision. So you know the saying that it takes 10,000 hours to become an expert at something? Well, you're not going to have the time if you've got a day job to be putting the 10,000 hours into property investment. So we highly recommend going to a buyer's agency. At Valmika Buyer's Agency, we put in the hours significantly more than 10,000. We've been in the game for more than 10 years, and especially in the private equity space in multi-billion-dollar funds. So our experience level would definitely be beneficial when buying a property. So the saying, you make your money when you buy a property, not so much when you sell it. And that's very true. If you can buy at a great level, you leapfrog your investment returns because you're compounding off that lower base. So your returns are immediate straight away when you purchase. And this is what we strive for our clients. So not only do we put you in the right property in the right area that maximizes your returns, but you get in at a good price as well. So that's what we strive for in our agency. Secondly, get a mortgage broker. Mortgage brokers are very handy. So a couple of years ago, banks dominated when it came to sourcing business for mortgages. But that trend has changed. It's moved more to mortgage brokers because they get access to a wide variety of banks that you wouldn't be able to do yourself. And as a result, you get a very competitive interest rate and terms on those interest rates as well, because they create their competition amongst the banks for you. So it's really a good idea to get a good mortgage broker. Thirdly, because we all live busy lives, unless you're doing this full time, it is highly recommended to get a good property manager. So a professional property manager can handle tenant screening, rent collection, property maintenance, ensure a smooth rental experience. This is well worth it, especially if you do not have the time or you don't have the experience to do this yourself. Okay, so lastly, what are the strategies for success? Number one, as I said, it's about the level that you purchase a property and how you can get ahead in compounding at a greater return than the rest of the market is if you are able to buy well in the right suburb. And to do that, you have to have strong negotiation techniques. In order to do that, it takes practice. So you need to hone your negotiation skills, potentially secure a lower price and improve your investment return. If you're not good at negotiation, it's well worth it to get an expert to do this for you. And that's where the buyer's agency services come in. Secondly is your mindset. Property is generally a long-term game. So you need to have a long-term mindset. So residential property investment is a marathon. It's not a sprint. So you need to be prepared to hold on to your investment for the long term to ride out market fluctuations and maximize potential returns. And then lastly, just remember it's a continuous learning process. So you need to stay informed about market trends, the legislative changes, and tax implications for your property investment. I hope this podcast was valuable. If you have a topic you would like me to discuss on the next podcast, please send me an email at info@valmikaproperty.com and I will gladly do a podcast for you on it. If you like this episode, please give me a thumbs up. It'll help me keep the lights on, so to speak, and we will see you on the next one. Thanks for tuning in to today's episode of the Valmika Property Investing Podcast. If you're interested in our services, please visit us at valmikaproperty.com. Remember, the content shared in this podcast is for entertainment purposes only. For personalized financial advice, always consult your trusted financial advisor or professional. See you in the next episode.